All right, good afternoon, everyone. Welcome to today's headline roundup. Hope everyone had a great Independence Day holiday last week. Dennis, are you ready to roll?
I am, Mark. I thought I'd start with a little video, and I'll save some bandwidth here in a second. But welcome back after a 1-week hiatus. Again, as Mark said, hope everybody had a terrific 4th of July holiday. No shortage of things to talk about as far as the economy goes, as far as the investing markets go. So I'll jump in. As I go through the material today, if you have any questions, go ahead and type those in the questions box on the right-hand side of your screen. Mark's going to help me watch for those. And as those questions pop up, we'll pause and do our best to answer those. Back again next week live. Let's jump into what we want to talk about today. There is some proof of an artificial economy that I want to share with you. This has been an overriding theme. I've been talking a lot about the fact that today's economy is artificial, propped up by Federal Reserve monetary policy. When you have artificial money, you get an artificial economy. John Hussman of Hussman Fund says we're not there yet. I've got an update for you on credit card debt. Elliott Wave, I have interviewed Robert Prechter, who wrote a book called Conquer the Crash. Bob is the founder and president of Elliott Wave International. I'm going to share with you some of their analysis that confirms the revenue sourcing planning approach that so many of you are using. The average car payment has now reached an all-time high, and worldwide, the dominant economic story is inflation. So again, a lot to talk about. Ben Hunt on Twitter published this, saying that data goes back 70 years. This chart actually goes from 1951 to 1986. So this is the first half of the 70 years of data. There is 35 years from 1951 to 1986. The yellow or orange, I should say, the orange line on the chart is household and nonprofit net worth. The blue line on the chart is gross domestic product or economic output. You see that those lines are basically the same line from 1951 to 1971. And then you see that when Nixon eliminated the link between the dollar and gold, you started to see some variation. But they still roughly tracked each other because monetary policy hadn't gotten too far out of whack. However, when you look at the time frame from 1986 to 2021, the second part of the data here, Ben Hunt notes that in the late 1990s, the Fed began to use monetary policy as a political tool to make us richer than our economy could grow, inflating home prices and financial asset prices without, they thought, ever triggering wage and price inflation in the broader economy. And he concludes by saying, oh, well, we had a good run. And when you look at these two lines, the data is really shocking. Look at what's happened to net worth as opposed to GDP. Now, if you think about GDP or gross domestic product as income, and think about the orange line, net worth as it is, it's really difficult to build net worth without increasing your income at roughly the same pace. If you think about that and apply it to your own personal situation, if you're making $100,000 a year, it's really going to be tough to significantly grow your net worth exponentially anyway, unless you're making more than $100,000 a year, because your fixed expenses stay about the same, presumably. That's not what's happened. Net worth has increased far faster than income, which offers proof, I believe, of this artificial economy. And I think you're going to see this everything bubble, as I call it, collapse, and you're going to see that orange line fall back to the blue line. And the other thing to keep in mind is that, as we talked about over the last couple of weeks in Portfolio Watch, we are now in a recession, so GDP is now contracting. So that means that net worth or these asset resets may have further to go. John Hussman wrote, "We're not there yet." John Hussman is a terrific commentator. He is a manager of Hussman Funds, and he wrote about, started his article with a quote from Lao Tzu, who wrote, "A journey of 1,000 miles begins with a single step." In recent months, the financial markets have taken the first step toward normalization. The normalization, if you go back and think about that chart that we just viewed, is that we have to see net worth now revert back toward income. He said, unfortunately, having taken one step, the most prominent question we hear is, are we there yet? In other words, is the correction over yet? Have we seen the bottom in the market? Hussman says, if there means valuations anywhere near levels that are consistent with historically run-of-the-mill long-term returns, if there means a monetary policy stance anywhere near something that would promote productive capital allocation without speculative distortion, if there means financial market capitalizations that can actually be served by the cash flows generated by the economy, providing adequate long-term returns without relying on endless expansion and valuation multiples, then no, we are not there. I couldn't agree more. We are definitely not there. Hussman provided this chart. He said the problem is that after a decade of deranged monetary policies, strong words, but accurate words, these deranged monetary policies that ultimately amplified speculation beyond 1929 and beyond 2000 extremes, we are so far from normal that arriving anywhere near that neighborhood will be a journey. The recent market decline has simply retraced the frothiest portion of the recent bubble, bringing the most reliable market valuation measures back toward their 1929 and 2000 extremes. So in other words, the recent correction in the market just got us back to the extremes we saw in 1929 and 2000. The extremes that we just saw in market valuation are greater than any extremes we've ever seen at any point in history. Now, Hussman said, for our part, we don't need to assume and certainly don't need to rely on a return to historically run-of-the-mill valuations, nor would we rule it out. We should allow for periods of market free fall, as well as fast, furious, prone to failure advances to clear oversold conditions. Our practice, our discipline, is to remain in the present moment. We want to align our investment outlook with observable and measurable conditions, such as valuations and market internals. He said the present combination of extreme valuations and ragged market internals has created a trapdoor situation. Improvement in the uniformity of market internals could encourage us to lean more constructive even here. The chart shows historically the expected 12-year nominal returns if you're invested 60% in stocks, 40% in bonds, which is a pretty normal recommended valuation. Now, if you take a look at this chart, it goes all the way back to 1928. And the way this data is calculated, the way this forecast is calculated is taking a look at valuations. The blue line on the chart is the estimated 12-year nominal annual return on a conventional 60-40 mix. The red line is the actual return. So when you see when we reach extreme levels that the market automatically corrects, and this being the case, you can see that the anticipated 12-year returns are significantly below anything that we have seen. Now, Hussman talks about a quote from Benjamin Graham and David Dodd, and Benjamin Graham was Warren Buffett's mentor. So pretty good company here. They said this: during the latter stage of the bull market culminating in 1929, the public acquired a completely different attitude towards the investment merits of common stocks. The public looked at investing in stocks differently. Why, Graham asks, did the investing public turn its attention from dividends, from asset values, and from average earnings to transferred almost exclusively to the earnings trend, the changes of earnings expected in the future? In other words, instead of looking at what's actually going on, investors were betting on what might happen. The answer was, first, the records of the past were proving an undependable guide to investment, and second, the rewards offered by the future had become irresistibly alluring. Along with this idea as to what constituted the basis for common stock selection emerged a companion theory that common stocks represented the most profitable and therefore the most desirable media for long-term investment. This gospel was based on a certain amount of research showing that diversified lists of common stocks had regularly increased in value over stated intervals of time for many years past. Graham stated, these statements sound innocent and plausible. They're believable. Yet, there were two weaknesses that were concealed. First, they didn't recognize the fundamental distinctions between investment and speculation. The second was they ignored the price of a stock in determining whether or not it was a desirable purchase. They just bought stock. It didn't matter what it was selling for. The notion that the desirability of common stock was entirely independent of its price. In other words, it didn't matter what you paid for it, just buy it. Graham says that seems incredibly absurd, yet the new era theory led directly to this thesis. And if you think about what just happened in the markets, you've got companies that have not made a profit that had their shares really run up. Now, when you have that situation, Graham concludes by saying the outcome of this doctrine could not be anything but tragic. Now, Hussman said, I should post this every month. He said, it's a great description of how investors became willing to passively invest without worrying about what stock valuations were. Yet, he says, valuations are the most reliable gauge of long-term market returns as well as losses. So we are on, as Hussman says, we are not nearly there yet. There is going to be a lot more downside to get back to normal valuation levels or more normal valuation levels. Hussman says the danger for investors is they have learned all the wrong lessons from this bubble. They've come to believe that valuations can be ignored and the Fed easing is omnipotent. They've come to believe that it always comes back, they meaning investors. Investors, have learned to embrace passive investing because they look back over their shoulder at prices that have gone nowhere but up. And they conclude that attending to valuations would have been costly and useless. They tend to think that investing based on what you'll get back in terms of earnings is obsolete, it's antique, and it doesn't apply anymore. But Hussman said investors learn the wrong lessons because they imagine that if valuations are not consistently useful in and of themselves, they're not useful at all. So we have a long way to go yet, according to Hussman. Now, consumers are dealing with inflation, as I've reported earlier, by resorting to credit cards. Personal savings is down. The personal savings rate has dropped from 34% to 4% the last I looked in a couple of years. And credit card debt this year from February to March doubled. I wanted to give you an update. This is from Zero Hedge on Friday, July 8th. Last month, when we reported that consumer credit numbers were an absolute shocker with another month of blowout revolving credit card debt, confirming that U.S. consumers had tapped out and were spending themselves silly with money they don't have, we said the hangover was going to be brutal and painful. Well, here we go, just a month later. The Fed released consumer credit data for the month of May, which confirmed U.S. consumers had maxed out their credit cards and the hangover has now indeed started. Starting at the top, if you take a look at March, which is what I just referenced, consumer credit rose 22.3 billion. That's starting at the top. And then in March, it went to 47.5 billion. Now we're starting to see a drop, which simply means there's no room left on the credit cards. Credit card charges are down because, again, people have maxed them out. Take a look at March on the chart and then take a look at the present time, and you see that credit card usage has dropped significantly. Bottom line is this: the sharp drop in credit card growth is precisely why the second quarter GDP growth is on pace for a big slowdown. And as I've said, I believe that the second quarter growth will be negative, as was the first quarter, and we will be in a technical recession officially at some point here in the near future. The article continues and says, but what's worse is that once the mass layoffs kick in addition to the soaring inflation, at a time when most marginal credit cards are maxed out, the pain across U.S. consumers will be unbearable, as it will come just as most households are tapped out and no longer have dry power on their credit card for discretionary purchases. In short, the recession, which unofficially started in the first quarter and worsened in the second quarter, is about to get much worse in the third quarter, when the key support pillar of the U.S. economy, which is consumer spending, goes into a reverse now that there's no room left on credit cards. And the reminder there is more than 70% of the U.S. economy is dependent on consumer spending. Elliott Wave is a very useful tool in tracking where markets have been, in my opinion. And Elliott Wave had an article written by Bob Stokes that talks about the fact that they believe we are heading into a hard-hitting bear market, similar to what we saw in 1929 to 1932. And it confirms the revenue sourcing approach to having two buckets of money, one safe bucket and one bucket that is invested to hedge inflation, although obviously revenue sourcing is our term, not Elliott Wave's. So let me give you just a bit from the article by Mr. Stokes. An important step in preparing for an historic bear market is to embrace cash or cash equivalents. If stocks are crashing, cash is a good place to be. Stokes says this may seem obvious, but even with the stock market in a downtrend, cash is shunned by many an investor, both retail and professional investors. A lot of these investors believe the bull market will resume, and it's going to resume sooner rather than later. It kind of goes back to what Hussman said. They think that the Fed is omnipotent. The Fed will not let the market crash. The May Elliott Wave Theorist, which is the monthly newsletter published by Elliott Wave, said this: the percentage of assets dedicated to equities in the American Association of Individual Investors members' portfolios remains near a bullish extreme. They think this is a correction, not a bear market. So all the members of the American Investing Association have been holding more stocks than cash. This is a chart that comes from the July Elliott Wave financial forecast. Notice that when you take a look at the percentages that households have in equities relative to their total assets, you see the latest reading is 27.5%. That's the end of the first quarter. It's higher than the peak reading at the tech stock bubble, which was 26.3%, and higher than it has been at any time in history. So again, that goes back and reflects what Hussman said. We have market extremes and we are not there yet. Professional market observers, Elliott Wave continues, dislike cash. Bloomberg reported that S&P analysts haven't been this bullish in 20 years. The point is this: if you have a portfolio of mainly cash, you'll be in the minority. And history tells us that that's usually the best place to be because the crowd is usually wrong. Elliott Wave then gives some good advice. Make sure your cash is kept in the safest institution possible. I've been a big advocate of corporate bond-based strategies. Elliott Wave International President Robert Prechter wrote this in the March Elliott Wave Theorist. Between 1929 and 1933, 9,000 banks in the United States closed their doors. That was well before a worldwide depression dominates our daily lives. You want to make sure that you have your capital in safe institutions. Prechter then talks about the fact that there is $250,000 of FDIC insurance. He said you should not rely on FDIC. If the bear market turns out to be as severe as Elliott Wave International anticipates, social and political turmoil are likely to erupt. Talks about the fact that you can go to Elliott Wave's website. I do interview Murray Gunn from Elliott Wave occasionally, and there is a free book about Elliott Wave available on their website. And they talk about the fact that the practical goal of this analysis is to identify when you should buy and when you should sell. Now, the average car payment has reached an all-time high. And again, let me remind you, pretty good turnout today here. If you have any questions, go ahead and type those in the question box. I'm not seeing any, Mark, but please interrupt if I'm missing them.
Yep. There is one before you get to this next topic.
Okay.
The question was, with the DXY hovering around 108, making things overseas more expensive, and with BRICS coming up with another reserve currency, what are the implications and what should we do?
Well, first of all, DXY measures the relative purchasing power of the US dollar relative to the major trading partners of the United States. So the DXY measures the dollar's purchasing power relative to the currencies of the 6 largest trading partners of the United States. And this index is weighted. So it's largely comparing the US dollar's purchasing power to that of the euro and the yen. So there's a lot of analogies you can use to describe the US dollar, but at this point, compared to the trading partners of the US, the dollar is strong. So it's like the cleanest dirty shirt, to quote John Rubino, or the tallest midget, to quote Gary Schilling. Whatever analogy you want to use, the dollar is strong on a relative basis, not on an absolute basis. And you know that if you're going to the grocery store or the gas station. We've seen a little bit of a reprieve here in fuel prices, but certainly inflation is still the dominant news story, as we'll talk about here in a second. So the second part of that question, Mark, was what should we do? At this point, I'm recommending that you continue to hold some metals in your portfolio, although they have pulled back. I believe that you're seeing a fair amount of price manipulation in that market, and I believe at a certain point you're going to see the fundamentals overcome the technicals, and I think the Fed will ultimately have to reverse course and not tighten. I think they will go back to a loose money policy, and I think that will then drive metals higher. So I'm not sure if I answered that question. I know I talked a long time, but Mark, did I answer that question?
I think you pretty well nailed it. Thanks.
Okay. Yeah, thank you. And if there is another question, just please interrupt me. This is from the Wall Street Journal. I read the journal on a regular basis. This article caught my eye. The $1,000 car loan payment, higher prices and interest rates push up monthly costs. The average monthly payment for a new car hit an all-time high, and it's near a record level for used cars. So the article says that consumers have never paid more to finance their cars. Monthly payments on loans given out in June to buy a new car averaged an all-time high of $686 a month. That's according to Edmunds. That's up 4% from January and 13% above a year ago. That's a pretty good indicator of the rate of inflation. If you're going to buy a new car today, you're going to pay 13% more than you would have a year ago for a monthly car payment. That's 13% average annual inflation to buy a new car. The article says a growing share of people are paying much more. 12.7%, let's call it 13% of new car buyers who took out a loan in June have a monthly payment of at least $1,000. That's a big number. That's like 1 in 6 to 1 in 7 new car buyers are paying at least $1,000 a month. That share is up from roughly 7% a year earlier. 5% in June of 2019, and if you go back to 2010, only 2% of new car buyers had a payment of $1,000 a month or more. This shows you the share of new car borrowers with monthly loan payments of $1,000 or more. And you see that that number is going up exponentially here since 2020 when the currency creation began in earnest. Now, the article makes an interesting point. In some ways, the car market mirrors the dynamics of the housing market, which has been upended by the pandemic and its lingering effects. Now, I would argue that currency creation has had more of a negative effect on the car market and the housing market than the pandemic. Like many measurements, the expanding size of car payments presents a mixed view of the economy. On one level, the increase in loan balances and monthly payment obligations points to ongoing strength of U.S. households to afford big ticket expenses. Consumers prefer SUVs, pickups, and other expensive types of vehicles when they go buy them. However, the article said a lot of buyers could find themselves struggling to pay for their vehicle, especially those who don't want to buy but they're forced to buy because the other car finally gave up the ghost. Missed payments among consumers with low credit scores are starting to go up. Many of these borrowers will find themselves unable to buy. And people that have cars coming off lease are finding that they're having to pay more to get their next car because car costs are up and interest rates are also up. And this shows you the average new car payment and used car payment on the chart going back to 2019. So you see the average new car payment has increased from about $550 a month to just under $700 a month since 2019. The average used car payment from about $400 to a little over $550. There's an example in the article. Abigail Roberts of Los Angeles had to buy a car after her old vehicle broke down. She was hoping to keep her payment at about $300 a month, but the best she could find was a 2019 Hyundai Elantra with monthly payments for 6 years at $400. Roberts withdrew half her savings and borrowed money from a family member to scrape together a down payment. She said, the car wasn't in my budget, but I didn't really have a choice, and I'm worried about keeping up with the payments. Car loan originations are falling. There were 6.3 million new and used car loans originated during the first quarter of this year, which is down 5% from the same period a year ago. Annual percentage rates on new car loans average 5.2%, up from 4.4% in February. So interest rates are rising. That makes payments go up. So a lot of buyers now are stretching the loan out. Instead of 5 or 6 years, they're taking out 7-year loans or longer. And when that happens, of course, you get upside down in a car. You end up owing more on a car than it's ultimately worth. Finally, worldwide inflation is causing pain. This is my last topic. So if you do have a question, type it in the question box. This is from London. This is from the Wall Street Journal. Rampant food inflation is roiling the world's least developed nations. It's also hitting poor people in rich countries. A food bank operator in Norway, which is far from a poor country, said it's distributing 30% more food from the food bank than it was last year at this same time. Food bank usage is on the rise in the US. Grocery stores report customers there are trading down. They're buying more store brand food. They're not buying expensive meat and fish. The UK has seen rising food prices. The UK's overall inflation rate officially hit 9.1% in May. Food prices rose 8.5%. John Allen, who is the chairman of Tesco, the biggest grocery store chain in Britain, told the BBC that we're seeing real food poverty for the first time in a generation. Imported food is becoming more expensive because the British pound is being devalued. Last month, the average price of cheddar cheese was up by 59% from last June. Milk was up 27% year over year. These sorts of prices are now unaffordable for many. Some 44% of adults polled by the UK's Office of National Statistics in May said they were buying less food because of the higher prices. Food banks are seeing a third more traffic in the UK, mirroring what's happening in Norway. The Food Foundation, a food and nutrition lobby group, found food poverty had affected 15.5% of Britons in the 6 months to April. That's up 7.6% pre-COVID. It describes food poverty as the state of being without reliable access to a sufficient quantity of affordable, nutritious food. So inflation is the story worldwide. I expect that we're going to continue to see inflation until it morphs into deflation following this historic path that we talk about so frequently. Mark, I think I went a little bit over here today, but let me just hang around for a minute in case there are more questions. And if you do have a question, type it in the question box on the right-hand side of your screen. And Mark, I'm going to lean on you as to whether or not we have any more questions, please.
No questions at this point. You got one to ask, throw it out there quickly. William asks, recession coming?
I believe that we're there, William. I believe the first quarter GDP now, when it was revised for the fourth time, is negative. The Atlanta Fed has a GDP Now program, and they estimate second quarter growth will be at 0%. That's their first attempt at telling us what the economic growth will be. So I expect that the subsequent revisions will be more negative. I believe the first quarter that has already been reported to be negative economic growth will be followed by negative economic growth in the second quarter. 2 consecutive quarters of negative economic growth or economic contraction is how a recession is technically defined. So I believe that we are there, and I believe it will become more apparent as the rest of this year plays out. I also believe markets will not react favorably to the news, as you might expect.
Clearly, you've done a great job today, Dennis. It doesn't look like we've got any more questions.
All right, everybody. Well, we'll be back again live next week. Thank you all for participating and getting the word out. Talk to you next week. Thanks, Mark. Appreciate it.
All right, we'll wrap it up there. Again, have a great week. We'll see you next Monday. Take care.